Hey everybody, this is Craig Moser. It is the 11th day of September. Believe it or not, this year's just cruising right along. 2020. Wanted to bring you some updates on what's happening in the markets so that you can stay in touch with us. So let me share a little bit with you. Let me move this over to another panel here. And hopefully we're looking at the Standard & Poor's 500 index here. So let me explain what we're seeing here. What we're seeing here is a one-year chart. So this is not even a one-year chart. This is a year-to-date chart showing what's happened in the S&P. So really, if you look at the start of where we were, that is about, I don't know, 32.58, something like 32.58, something along that range, and say, okay, where are we today? We're no further along, but you know, the excitement of a rebound and all of these other things that have been occurring, you know, a lot of people are pretty excited about, you know, how the markets have been doing. So let me see if I can sort of get you to zero. That's a one-year timeline. So we're a little better than we were at the beginning of the year. That's the best way for me to say that. And in between there, this area right in here, obviously there has been a great deal of volatility. So we made a fairly significant run back up from this bottoming that we did. And now here we are right in this range right here, and the markets are showing weakness. They're starting to have some selling volume, that type of thing. So as you're looking at what's happening, you know, just understand that there's a lot of dynamics in place here. Dynamic number one, interest rates. There aren't any. I mean, we make very little these days on interest. So please be aware that one of the dynamics of the stock market is money is trying to find a place that'll treat it well. And the stock market was a recovery vehicle down here. But that doesn't mean that it continues to go up. It may, but I don't know if it will or not. So at the end of this, what we're trying to get to is, you know, the stock market is fairly expensive right now. If we look at the Nasdaq, which is a little different, had the best run. So this one actually has done much better. The reason why? Technology. Technology has given us this return in this particular part or segment of the market. If you're looking at companies like over here on this side right here, you're looking at, you know, at Apple's and the Zooms and the Netflix and the Adobes, that's what's in this index. What's not in this index is things like Merck and Boeing and that type of thing. So this is a different selection. NASDAQ has different stuff in it. Just be aware of that. So as we're looking at stock markets, you know, where the technology is, that's where a lot of the growth has been. So what we're trying to get you to is an understanding that, you know, as these stocks go up, eventually they become overpriced, and then there are, you know, obviously more risk in an overpriced market. So we'll look, for example, at we're using Zoom right now. That's what we're talking on. So if we looked at Zoom, that's a good word for it, Zoom. So it peaked out right here. So if you were the buyer on 9/1, you're disappointed because Zoom is no longer going up. It did go up. It went up like a rocket ship when everybody went to working from home and the web and all that other stuff and having to communicate. But at this point, paying 486 times the trailing earnings on this company, it's hard to continue to buy it. Eventually it comes down to earnings. Can this company make any money and continue to grow its franchise? You know, if you compare that, say, to a company like Nvidia. Now, Nvidia, although it's trading at 90 times earnings, you know, they have some earnings. And so these expensive technology stocks will eventually have what we call mean reversion. They'll go down. You know, there's an average price for these. If we look, for example, at a 5-year window here for this stock, you can see a peak right here, which was 2018. It took until about right here to start to move back up from that bottoming that Nvidia had, and now we're again doing this skyrocket move up, but more volatility here recently. So just understand these are better to buy when they correct. There's nothing wrong with these companies. They're great, but you're seeing a lot of selling pressure coming in, and you just need to be careful. Let's look at the Dow, for example. So here's the Dow Jones, a different set of stocks. Over here on the right, if we look at the Dow, here's stuff in the Dow. So you have Amgen, Nike, Home Depot, 3M, Honeywell, Caterpillar, Dow, Procter & Gamble, fabulous companies. But bigger companies, most of them, not all of them, but the vast majority of them pay dividends. And so they're just a different group. And you can see year to date, we haven't had the recovery, or at least the growth that we did in the Nasdaq, that we did in the S&P. And the difference primarily is a lot more technology in those other two indexes. You don't have Facebook in here. You don't have Amazon in here. You don't have Twitter, those types of companies. So just understand that the differences in the indexes are a big reason why they're either doing great, Nasdaq, or doing okay, Dow Jones. Different metrics at play here. All right, so as we're pushing through this, the Dow for the year, okay. If you go back, say, and look at a 2-year window on the Dow, you can kind of see we're not making a ton of progress over the last 2 years. We were over here. So the Dow 2 years ago was, 26,145, and we're 27,662 coming off of a pretty significant bottom. So just be aware, this is going to be interesting as we get into this last quarter of the year. So let's look at things like Treasuries. I use iShares 7 to 10 year Treasury bond. This is sort of an index that is ran for bonds that are U.S. Treasuries maturing in about 7 to 10 years. So you can see we had a significant run up. Guess when? March. And then since then, it's been flat. So the yield on this, if you hold it for an entire year, it pays 0.088 cents a month. So you get a 1.35% yield if that holds. So the risk on this is that people will no longer invest here, because looking for the last 2 years, U.S. Treasuries are at an all-time high because interest rates are at an all-time low, and that's kind of how that works. Anyhow, just the aggregate, you used to hear at least Lehman Brothers bond aggregate. Looks very similar to the other. This is a year to date. Everybody's asking me about this. I don't have time to really explain this. Look at one of my previous presentations that I did on the market perhaps last month, and you can see right in here the Fed came in and supported the bond market. I won't elaborate too much, but you should read about this. This is not a normal market. High yield bonds, what we would call junk bonds, again, had that same action. The Fed's buying these bonds. So what's happening is you really don't know how much of these bonds are actually any good versus, I don't know, the higher quality stuff. So just be aware the bond market is not all the same. This one has a 5% yield, but it had a higher yield before and it's not at a higher price. So that means some of them probably aren't paying their interest. Be cautious here. Bonds are not great places to have the money unless you buy super high quality. If we look, for example, at, let's see if this is right. This is a index of the small cap. I think it's small cap 600, but you can see that has yet to recover for the year. If you look at mid cap stocks, yet to really recover from January. So really only the large growth style stocks have given us any returns. And most of that would be the Apples of the world, the Procter & Gambles of the world, companies that are not reliant on a piece of real estate, not reliant on people buying a car, those types of things. All right, so let's look at our foreign friends. We'll look at Europe, Australia, and the Far East, which would not be China and those guys. It would be more like Japan. And a similar chart pattern is arising here. You can see that really everybody is sort of stabilized. They've printed a bunch of money, so have we. And but we have really not demonstrated any growth. So let's look at Europe, Australia, and the Far East for 2 years, and you can see, about exactly where we were 2 years ago. You lose it, you make it, you lose it, you make it. That's kind of the world we're in right now. This is volatility. If you look at the emerging market piece, China is the largest in this index, but not the only piece. What you'll see here is a market that has basically recovered back to where it was at the beginning of the year, but with a significant drop. So if you were looking at a price at the beginning of the year, it opened up at 54.35. It went down as low as 35.66, so it lost $20 a share, and now it's 52.64, 65, something like that. So what's happening is recovery. Hopefully we'll get a handle on this COVID-19 virus somewhere close to the end of the year, and we'll find a way to move past it. It's a problem, and it's going to be a continuing problem. Gold. Let's look at gold for a minute, because that's a fascinating looking chart. Gold this year obviously went up. People are concerned about the dollar. With all this extra money that they've created, more liquidity, more volume in the system, gold, an alternative currency, has gotten a bid and has held pretty well right in here at the, you have to move the decimal, it's what, 1828.35, so $1,828 an ounce, give or take a little bit. Kind of expensive. I mean, if you were looking at down here, heck, it was a lot cheaper there, $400 cheaper to buy gold than it is today. And if we march this out for a 2-year look at gold, you can kind of see we're moving in at a pretty much a 2-year high. Gold has moved up a lot because, the dollar and different things like that are not as strong as they were. So here's your dollar chart. The US dollar was pretty darn strong, dollar versus yen, and now we're not so strong. So dollar index is, if we're selling to somebody, pretty good. If we're buying, not as good. So that's good for productivity if the dollar's down. All right, so I don't want to blow your mind with all this goofy stuff with the Fed and what have you, but did want to bring you some information. Wanted to make sure that you understand that markets are expensive. Markets are expensive, and I would not be surprised to see things like this S&P 500, draw down to maybe this 3,100 range. So don't let that freak you out. That is just a little bit of mean reversion, and we need these guys now to start earning some money. We don't need to pay up heavy for a lot of stocks. I'll use Apple as my example. When a stock trades at 34 or 35 times earnings, it's sort of expensive, okay? That doesn't mean bad. That just means a lot of people have bought the stock, and why would you keep on buying it once it gets too expensive? Same thing with a piece of real estate. If you were shopping for houses now versus shopping for houses 10 years ago, obviously the prices today are significantly higher. So can we maintain that and keep that going? The answer is, I don't know. You need to step back. I'm recording a meeting. Office staff. So where we're at today is a fairly expensive market that'll probably bring some value back down. So if you were an Apple buyer, maybe 100 would be sort of an entry point. Sounds good after the split, but nothing's really bad. We just need everybody go back to work. We need for our economy to begin to grow and this COVID-19 thing to get behind us. That's really the long and the short of it. Is a recovery in place? There's been a lot of recovery, especially in the stock market. Now we just need employment to go right. As people go back to work, You can blame anybody you want to, but really it was nobody's fault that this thing hit us the way it did. And so now, as people get back to the job, that should improve the economy. And then we're going to have to figure out a way to pay these bills off that we have created because of this virus. Anyway, that's it for this month. If you have questions, feel free to call us over here. The number is 336-448-1086, or you can visit our website. It's maestrowealth.com. And we have several tools and calculators and a lot of information that if you're trying to dig around and find some things to help you to start making financial decisions, be happy for you to go onto the site and use those. No problem there. And with that, we bid you a good September.